When we talk about money and how it moves around, Wall Street and the bond market are big players. Recently, Wall Street has been going up, and the bond market has been getting calmer. This has caught the attention of a lot of people who watch money. Welcome to Stock Whispers, your gateway to investment brilliance. Today, we're going to look at why this is happening, what it means for different people, and what it might tell us about how the economy is doing. Last February 6 was a day of modest gains and positive vibes on Wall Street. Let's start with the Standard & Poor's 500, or S&P 500 for short. It's a bit like the heartbeat of the American stock market, tracking the performance of 500 large companies listed on stock exchanges in the United States. That day, it rose by 11.42 points. Now, in the grand scheme of things, a 0.2% increase might seem small, but it's actually a strong signal of stability, especially considering it almost reached its highest point ever recorded just last week. Moving on to the Dow Jones Industrial Average, often just called the Dow. This is another key indicator, focusing on 30 prominent companies. It saw a rise of 141.24 points, marking a 0.4% gain. This kind of movement shows confidence and growth, particularly in the industrial and financial sectors that make up a big chunk of this index. And we can't forget about the Nasdaq Composite, heavily influenced by tech giants. With an increase of 11.32 points, or 0.1%, it might seem like the smallest mover of the day. However, in the tech world, even small gains can reflect significant trends, from new tech innovations to shifts in consumer behavior towards digital services. These numbers are much more than just statistics. They're the pulse of the market, giving us a glimpse into the overall health of the economy, investor sentiment, and future prospects. Seeing gains across these major indexes is like a collective nod from investors that, despite uncertainties, there's optimism in the air. Now, let's take a moment to explore a key player in our economic landscape, the Federal Reserve. You might hear people call it the Fed for short. Think of the Fed as the overseer of our economy, guiding it through the ups and downs of financial cycles. One of their main tools? Interest rates. But what's been happening recently has caught everyone's attention, and it's crucial to understanding the market's movements. Interest rates are basically the cost of borrowing money. When the Fed lowers these rates, it's like making it cheaper for businesses and people to borrow money. This can lead to more spending and investment, which can boost the economy and, by extension, stock prices. On the flip side, when the Fed raises rates, they're putting the brakes on, aiming to slow down inflation and cool off an overheating economy. But here's the twist. Recently, the Fed hinted that it might not cut interest rates as soon as many had hoped. This news was a bit of a surprise and has caused some worry among investors. Lower interest rates can be like a shot of adrenaline for the stock market, so the idea of waiting longer for that boost has left some folks feeling impatient. Despite this, it's fascinating to see our economy holding strong. In a world where financial markets can swing on the hint of change, the resilience of the US economy is noteworthy. This strength is a double-edged sword, though. On one hand, it's a testament to the robustness of our economic system. On the other, it means the Fed is more cautious about cutting rates, choosing to wait and see how things unfold. This cautious approach by the Fed has led to a shift in expectations. While many were eyeing early relief from high rates, the new outlook suggests we might not see any cuts until later in the summer. This anticipation game is a delicate dance, influencing everything from consumer confidence to corporate investment plans. So, what does this mean for you and me? Well, it means keeping an eye on the Fed's moves is more important than ever. Their decisions on interest rates directly impact our mortgages, car loans, and even the returns on our savings. Plus, for those invested in the stock market, these decisions can sway market trends, making some days feel like a roller coaster ride. But here's the kicker: even without immediate rate cuts, companies can still do well if they're making good money. And guess what? Some are knocking it out of the park. GE Healthcare Technologies, for example, saw a big jump of 11.6% after sharing they made more money than everyone thought they would. And Palantir Technologies, a big name in artificial intelligence, soared 30.8%. Then there's Spotify, the music streaming service, which bumped up 3.9% thanks to adding more subscribers than expected. These are the kinds of stories that can cheer up the market. Not all news was sunny, though. FMC, a company that helps protect crops, saw its stock drop 11.5% due to not so great earnings, partly because of drought in Brazil. And Fiserv, a tech firm, fell 2.1% after its revenue missed expectations. Switching over to the bond market, it's been a bit of a roller coaster. The yield on the 10-year Treasury note, which moves opposite to its price, dialed back to 4.09% from 4.17%. This is a bit like the bond market taking a deep breath after some recent excitement. Why does this matter? Well, bond yields give us clues about what investors think is going to happen with the economy, from interest rates to inflation. A calm bond market can mean a more stable environment for stocks. Looking around the world, we saw some big jumps in Chinese stock markets, thanks to some new measures aimed at boosting confidence. Hong Kong's market leaped 4%, and Shanghai's went up 3.2%. It's a reminder of how connected global markets are and how actions in one country can ripple through others. And there's more news on the horizon, with big companies like CVS Health, Walt Disney Co, and PepsiCo set to share their earnings reports this week. These reports could shake things up or keep the calm going. So, what does all this mean for you? Whether you're investing in stocks, bonds, or just keeping an eye on the economy, these movements tell us a story. A calm bond market, companies making money, and a cautiously optimistic stock market suggest that, for now, things are looking stable. But the world of finance is always moving. Interest rates, earnings reports, and global events can all cause waves. That's why we'll keep breaking it down for you, making sure you're up to date with what's happening and what it could mean for your wallet. Thanks for tuning in to Stock Whispers. If you enjoyed this deep dive into Wall Street and the bond market, give us a thumbs up, subscribe, and hit that notification bell so you never miss out on our expert investing advice. Until next time, keep listening to those whispers and let them guide you to your next big win. See you soon!